It sits on your kitchen counter, a standard white envelope with the logo of RBC, TD, CIBC, or Scotiabank in the corner. You've been dreading this letter for months. You know what's inside, but you haven't wanted to face it. You finally tear it open. You scan the page, past the polite legal jargon, until your eyes hit the bold numbers at the bottom. Your heart stops. Your hands start to shake. New monthly payment, $4,800. You blink. You reread it. That can't be right. You were paying $2,600. That is a $2,200 increase every single month. That is $26,000 a year. After tax money, gone, poof, vanished, into the pockets of the bank shareholders. You do the mental math instantly. You cut the Netflix subscription. You cancel the family vacation. You stop eating out. It doesn't matter. You are still short. You look around your living room. You look at the family photos on the wall. And the terrifying realization washes over you. We cannot afford to live in our own house anymore. This is not a nightmare. This is the reality facing 2.2 million Canadian families in 2026. We are standing at the edge of the mortgage renewal cliff. For 5 years, Canadians were addicted to cheap money. We bought houses we couldn't afford because the interest rates were 1.5%. We trusted the Bank of Canada when they said rates would stay low. We were lied to. Now, the bill has come due. The trigger rates have been hit. The negative amortization shield is being removed by the regulators, and the banks are sending out renewal letters that are effectively eviction notices. In this video, I am going to expose the payment shock crisis that the mainstream media is trying to downplay. I am going to show you the internal bank data that proves how many people are actually underwater. I'm going to explain why shopping around for a better rate might be legally impossible for you due to the stress test trap. And, crucially, I am going to walk you through the 3 desperate options you have left to save your home from a power of sale. Before we dive into the numbers that Tiff Macklem doesn't want you to see, I need to be real with you. This is a brand new channel. We launched Housing Canada because the CBC and the Globe and Mail are too afraid to tell you how bad this crash is really going to be. They depend on real estate ad revenue, which we don't. We are here to tell you the unfiltered truth. But right now, the algorithm doesn't know we exist. If you are a homeowner, an investor, or just a Canadian worried about your financial future, I need you to do one thing. Take 2 seconds right now and click that subscribe button. It costs you nothing, but it helps us get this warning out to families who are sleepwalking into bankruptcy. Now, let's look at the math. Let's go back to the scene of the crime. 2021. Do you remember what Tiff Macklem, the governor of the ECTR, Bank of Canada, told us? He stood in front of the cameras and said, "Interest rates will remain low for a long time." Canadians listened. We went out and signed variable rate mortgages. We signed 5-year fixed terms at 1.7%. We bid $200,000 over asking price on townhouses in Brampton and condos in Vancouver because money was free. Fast forward to today, January 2026. Those 5-year terms are up. The 1.7% rate is gone. The new offer on the table is 5.5% or 6%. To the average person, 1.7 to 5.5 sounds like a small jump. It's just 4%, right? Wrong. In the world of debt servicing, that is a 300% increase in interest costs. Let's use a real example. A typical family in the GTA, Greater Toronto Area, or the Lower Mainland in BC. They bought a home for $1 million in 2021. They put 20% down. They have an $800,000 mortgage. At 1.7%, their monthly payment was roughly $3,200. It was tight, but manageable. Now, they have to renew that $800,000 balance at 5.5%. The new payment, $4,900. That is an extra $7,200 a month. That is $2,400 a year. Where does an average Canadian family find $20,000 in post-tax cash? Salaries haven't gone up $20,000. In fact, with inflation and the carbon tax, disposable income has gone down. This family is technically insolvent. They just don't know it yet because they haven't signed the renewal paper. But wait, it gets worse. Let's talk about the variable rate victims. If you had a variable rate mortgage with fixed payments, you might think you are safe. You've been paying the same amount every month, right? This is the biggest trap of all. It's called negative amortization. Because rates went up so fast, your monthly payment wasn't even covering the interest. It definitely wasn't paying down the principal. So, every month, the bank took the unpaid interest and added it to your debt. Your mortgage didn't go down, it went up. You might have started with a 25-year mortgage. Today, on paper, your amortization period is 70 years, or 90 years. You are effectively renting the house from the bank forever. But here is the cliff edge. The Canadian banking regulator, OSFI, has ordered the banks to clean up these books. When you go to renew in 2026, the bank cannot give you a 90-year mortgage. They are legally required to snap you back to the original schedule. So, not only do you have to pay the higher interest rate, but you also have to pay down the extra debt you accumulated over the last 3 years. And you have to do it in a shorter time frame, 20 years left instead of 25. This is the triple whammy. This is where we see payments jumping, not just by 40%, but by 60% or 70%. This is a mathematical impossibility for the working class. And what is the bank's solution? They will call you. They will sound very helpful. Mr. Smith, we see you might struggle with the new payment. Why don't we extend your amortization back to 30 years? This sounds like a lifeline. It lowers the monthly payment slightly. But look at the cost. By re-extending to 30 years, you are adding hundreds of thousands of dollars in interest over the life of the loan. You are agreeing to be in debt until you are 85 years old. You are sacrificing your retirement to save your house today. It is modern-day serfdom. You work, you pay the bank, you die. You own nothing. Now you might be screaming at the screen, "I'll just switch banks. I'll go to a different lender who offers a better rate." This brings us to the mortgage prison. In a normal market, you shop around. Competition is good. But in Canada, we have the stress test. Even though you have been paying your mortgage perfectly for 5 years, even though you have never missed a payment, if you want to switch from TD to Scotiabank to get a lower rate, Scotiabank is legally required to stress test you. They have to check if you can afford the mortgage at 7.5% or 8%. But guess what? You barely qualified at 1.7% in 2021. You definitely don't qualify at 8% today. So Scotiabank says, "Sorry, we can't take you. You are rejected. You are forced to go back to your original bank." And your original bank knows you are trapped. They know you can't leave. So, do they offer you their best rate? Of course not. They offer you a terrible rate because you have zero negotiating power. You are a prisoner in your own mortgage. This situation is creating a level of panic we haven't seen since the early 90s. I speak to mortgage brokers in Toronto and Vancouver every day. They tell me grown men are crying in their offices. They tell me about families who are putting groceries on credit cards just to keep the mortgage afloat. They tell me about the private lending death spiral. This is when desperate homeowners go to private lenders, shark loans, to bridge the gap. They take a second mortgage at 12% or 15% interest just to pay the first mortgage. It buys them 6 months, maybe a year, but it eats all the equity in the house. When the money runs out, the private Lender forecloses instantly. It is not a solution. It is financial suicide. So, is there any hope? What happens when 2 million people simply cannot pay? We'd start to see the inventory pile up. Look at the condo market in Toronto. Look at the detached market in the suburbs. Listings are skyrocketing. Sales are plummeting. This is the forced seller wave. These aren't people selling because they want to move to Florida. These are people selling because the bank letter gave them no choice. But here is the problem with forced selling. Everyone is doing it at the same time. When you have 10 houses on the street for sale and only one buyer, the price crashes. We are already seeing properties selling for $200K or $300K less than they were bought for in 2021. This creates negative equity. This is the scenario where you sell the house, you give all the money to the bank, and you still owe them money. Imagine walking away from your home, homeless, with a $50,000 debt still hanging over your head. That is the tragedy of 2026. And we need to talk about the power of sale. In the US, they have foreclosure, which takes years. You can live in the house for a long time while the court fights it out. In Canada, we have power of sale. It is brutal. It is fast. If you miss a few payments, the bank doesn't take ownership of the house. They simply take the right to sell it. They evict you. They put it on the market. They sell it for whatever price they can get to cover the debt. They don't care about getting the highest price. They just want their money back. If they sell it cheap and it destroys your equity, too bad. We are seeing power of sale listings spike in Brampton and Milton in Surrey. The for sale signs are popping up like mushrooms. So, what can you actually do? If you are holding that letter in your hand, or you know it's coming in the next 6 months, you need a strategy. Panic is not a strategy. Here are the 3 options, ranked from painful to nuclear. Option 1, the lump sum, Hail Mary. If you have any savings, any investments, or maybe family help, now is the time to use it. Most mortgages allow you to make a lump sum payment, usually 10-15%, directly onto the principal before you renew. If you can throw $50,000 or $100,000 at the mortgage before the renewal kicks in, you lower the balance. This means the interest doesn't hurt as much. It might bring your monthly payment down from impossible to just painful. It sucks to use your savings, but it saves the house. Option 2, the shop around. Bluff. Even if you think you won't pass the stress test, try. Call a mortgage broker, not the bank specialist. Ask them to shop the market for you. Sometimes there are insurable transfers. If your mortgage was insured, CMHC, when you bought it, you might be able to switch banks without the stress test. Many people don't know this rule. If you can switch, you might save 0.5% or 0.7%. That saves you hundreds of dollars a month. Do not just sign the first paper your bank sends you. That paper is an opening offer. It is a ripoff. Negotiate. Option 3, the strategic sale. This is the hardest pill to swallow. If you do the math and you are negative $1,000 a month and you have no savings, sell. Now, do not wait for the bank to take it. If you sell now, you control the price. You control the showing times. You might walk away with a little bit of equity. If you wait for the power of sale, the bank adds $30,000 in legal fees to your debt. They sell it at a discount. You walk away with nothing. It is better to rent for 3 years and rebuild than to go bankrupt trying to hold onto it like a falling knife. There is no shame in renting. There is shame in letting the bank ruin your financial future for a decade. The Canadian housing dream has become a nightmare for an entire generation. We did what we were told. We went to school, got jobs, bought houses, and now the system is punishing us for it. The government is talking about mortgage charters and relief. But let's be honest, they aren't coming to save you. They can't bail out everyone. It would cause hyperinflation. You're on your own, but you don't have to be uninformed. This channel is going to track the renewal crisis. Week by week, I will be interviewing brokers. I will be showing you the real listings where prices are crashing. I will be exposing the new tricks the banks are using to trap you. You need to stay ahead of the curve. So I have a question for you today. I want you to go to the comments section below. Question: if your mortgage payment went up by $500 next month, could you afford it? Type yes or no. I want the world to see the real stats, not the fake government stats. Let's show them the reality of the Canadian homeowner. If this video opened your eyes, please hit that like button. It helps the video spread to people who need this warning. And most importantly, subscribe. The next video is about the capital gains tax change that is destroying the cottage market. You do not want to miss that. Protect your wallet. Protect your home. I'll see you in the next one.